Hello, everybody, and welcome back to the Tax Hacks Podcast. I am your host, Trevor LaParle, back again. And of course, Kevin Brunner, always here with me. Kevin, how's it going?
Going good.
We survived a hurricane.
We did.
Somehow, some way.
We got a hurricane and an earthquake and 3 inches of rain. And I was waiting for the frogs and the flies and all the other pestilence to come. But
it's a sign of the times, huh? We're getting there, but we can still do our podcast. Is all that matters, right?
Yeah, we can still do that.
Well, today's podcast can be a little bit different. We're actually responding to a lot of the comments that you guys have had about a couple different things that have come up. There's been recently some IRS letters coming out and different things that Kevin's going to expand upon. That involve monetized installment sales. Monetized installment sales are a lot different than installment sale trust. And we're going to go over that today, clear up any confusion, because a couple of you guys were asking about, are you guys going to have to, close up shop, things like that. But completely unrelated to what we do. So Kevin, give us a brief rundown of what a monetized installment sale is, and then we kind of break down how things are a little bit different.
Well, let me just summarize this. Just because Chevy had a recall and has to pull a bunch of cars off the road doesn't mean Ford has to stop selling cars. Okay, so I mean, that's a perfect metaphor for this, because they're both called vehicles. But they're two different manufacturers, they're two different models. One doesn't apply to the other. So a monetized installment sale is actually permitted, even under current IRS. They have no problem with it if it is farmland or farm product. So let me explain farm product. You picked the tomatoes, you sold the truckload of tomatoes to the place where they're going to get processed. Going to become ketchup, become tomato sauce, whatever, right? The sale of those raw tomatoes over, you can defer the tax on that using an installment sale trust. All right. And you receive about 96% of the invoice back liquid and don't have to pay the tax for as much as 40 years or 30 years, 30 years. Once it's ketchup, once it's been smashed or altered. So when you sell the grain to the granary, you can defer the tax on that. When you sell the cannabis before it's been processed, it's still the leaves and the buds, you can defer the tax on that using installment sale trust. Once the grain has been milled and it's now flour, it is now a food product, you can't do that. You can sell the beef while it's still on the hoof. You can't sell it once it's been butchered, right? Even though it's not been cut up into steaks yet. So monetized installment sale for farm is still fine. We have a whole program for that. Monetized installment sale for everything else has never been allowed. And it was very clear in the tax code. But there were two groups. One's out of Idaho named Stan Crow. He's been fighting with the IRS for 10 years. The IRS, I don't know why they haven't even put the guy in handcuffs at this point, because he's harmed, 1,000 people. At this point, it's criminal what he's doing. And that's who the IRS is going after. And there's about a dozen other little guys around that are doing that. He may go to jail before it's over with. I know he's got hundreds of clients being audited and losing. But a monetized installment sale is not what we do. So these IRS things and all the people that are up in the air and competitors to our program are pounding their drum. Oh, look, don't do this. Come see us instead. That's like, no, and no. And so we yesterday had a very long conference call with legal counsel, tax attorneys at two firms and all of that. And we all came to the same conclusion. The IRS letter actually spells out this is installment sale or a similar transaction. Our transaction is not similar. There are 7 points in the letter from the IRS, and this is just a proposed change in rules. They're just saying what they're proposing to do. This still has a long way to go. This could take 2 years to play itself out. I mean, it can very easily take 2 years for these processes to go through. This one probably won't. This one's pretty straightforward. But there are 7 things in the letter. 4 of the 7 aren't us. I mean, it's clearly we're not even similar based on the legal standard. Now, what you and I think the word similar means and what it means under the legal standard are 2 entirely different things. So the installment sale trust is fine. It's completely fine. We know it's fine. They're not looking at us. They're not worried about us. We just have no problems. We don't even get audits. It's just, Because we report it in the forms exactly as the transaction happened. So, I mean, we're already reporting it in the forms, following the IRS's instructions and forms on how to report it. So I know I'm a little excited about this, but there are some people out there that are misinforming some people and causing problems where there aren't any, but they have a self-interest in doing so because they're at the Ford dealer and they're telling you, oh, don't buy anything from Chevy. Well, it was one model that had a recall. Don't buy that one. You understand what I mean? And our dealership doesn't even sell that model. So it doesn't matter, right? It doesn't matter. Um, anyway.
Definitely. Yeah. It sounds like, a lot of it's just kind of like the thing where it's like, oh, someone's crying wolf, right? Oh, there's a problem. And now everybody starts freaking out. And then same guy's doing it. And it's like, okay, well, it seems like there's some back end, guess you could say, intentions that people are having.
Yes,
about
and
what's
it's
going on
very
there.
easy to get some CPA they've paid a fee to, and then a lawyer that they've retained and paid a fee to render an opinion that later in the fine print they tell you is not tax advice because they don't want to be held accountable to it, right? So when you do an installment sale trust with us, we don't have those disclaimers. We are advising you, and we are full well ready to accept the responsibilities of the advice that we give. We stand behind every bit of it 100%. I even tell clients if we're having a Zoom meeting or something, they're free to record the meeting and keep record of everything that was discussed during the meeting because we will stand by every word of it. We've been given legal counsel repeatedly. I'm coming up on 20 years doing these things. I've worked with a dozen law firms over the years. Right now, each time we go from law firm to law firm, we take a step up. The firm we use now is in the top 10 tax attorney firms in the nation, 300 plus attorneys on staff. Our lead counsel there taught master's in taxation classes at Harvard Law. He's published in Bloomberg. He publishes a monthly column. He is considered the premier expert in installment sale and anything related to installment sale, that section of the tax code. So furthermore, we're doing a Delaware statutory trust. That's the trust that's holding the assets. So rather than doing 1031 to a Delaware statutory trust, we're doing 453 to a Delaware statutory trust. And we're not doing any of the other things that are red flags. We don't do any of them. So it's...
So what do? Yeah, absolutely. Can you tell me a little bit more about the Delaware statutory trust for people who aren't too familiar with it?
Delaware statutory trust is the standard. They're used all the time for 1031. So you can 1031 your real estate and defer all the tax to a Delaware statutory trust that then goes out and buys commercial cash flowing real estate. So you and a whole bunch of people are all in this Delaware statutory trust that has a portfolio of income producing real estate. It is an option. Now, there is a problem there, though, unlike the installment sale trust. And sometimes a DST, a Delaware statutory trust, for a 1031 is an appropriate thing for a client to do. But you'll be in there 3, 4, 5 years, and then they sell off that portfolio. And you're given 90 days notice to go find something else for the money to go to, or it's going to be taxed. And it's very difficult to have liquidity if you need it in those things. You can't call the note because it's not a note. So it's not a bad thing. It just may or may not meet your objectives, your financial goals. It might pin you down. I mean, you don't want to be at an inconvenient moment in the real estate market and being told, you got 90 days to find a place to put the money or you got to pay the tax, right? So it's a situation a lot of people don't want to be in. By the way, we do have a lot of clients that will bifurcate and put some money in a Delaware statutory trust and some money with us through the installment sale trust. So the other thing that's unique with us is we don't commingle. Once the money's in the trust, that's unique trust, unique name, unique tax ID, unique investments. Your money's not commingled with anybody else's. So in these other REITs and these other DSTs, your money gets commingled. And if you need to get it out, it's difficult to do. But most of our clients, they park the money, they take the quarterly income. It's more than the rent was anyway in the case of real estate. So, and there's appreciation in the assets, usually better than the real estate would have appreciated. So Most clients are just on autopilot with us anyway. They just want income for the rest of their life without tenants and toilets in the case of real estate, or a business owner without losing, 30, 40, 45, sometimes 50% if they have to recover accelerated depreciation of the transaction just to state and federal taxes, depending on the state you're in. There's a lot of qualifiers there, but why not just take what would have been lost to taxes and turn it to an income stream? The other reason the IRS doesn't have any problem with what we're doing, and they never have, by the way, is because they're collecting income taxes every year on that income as it comes in. So if you'd have kept the property, you're paying income taxes on the income from the property, right? If you'd have kept the business, you're paying income taxes on the income from the business. Now you're just paying income taxes on the income from the trust. So you still got to pay taxes on the income portion of it. But it's just more income, even net of taxes, generally than the property would have ever generated. And but so the IRS doesn't have a problem. They don't view it as a step transaction or tax avoidance. They don't view it as any of those things. So,
Got it. So it sounds like for the most part, it's the type of transaction that's the issue that people are using the monetized installment sale trust for. That's more, for the farm agriculture side, but they're using it for alternate things that do not apply to what's in the tax code, right?
yeah. So here's what happens. They talk to us and they say, "Oh, the money's got to be in a trust, and I got to take quarterly income." Then they talk to the other guy and says, "Oh, if I get to keep 4%, I'll send you 96%, and you get to pay the tax in 30 years." Well, it's substance over form, which is a violation of the tax code. It's an intermediated transaction in a way that you can't intermediate. They don't accept that. We intermediate in a way that's fully acceptable, just like a 1031 would intermediate. So it's fully acceptable. And then you have constructive receipt of the proceeds. They say, "Oh, but I took a loan." Well, no, you can't collateralize the note. So there's like 7 ways they fail the tax test. They fail the test, right? So there's just no way, those would ever pass an audit. With us, we don't fail the tax test anywhere. In any point in the process, it doesn't fail the test that's on those types of transactions. So that's why we just never have any issues. But because it's called a monetized installment sale and we're called an installment sale trust, people conflate, oh, that sounds the same. It's not. But people do that because they're like, "Well, so I get 96% of the money back now. I'll take my chances with the IRS." I wouldn't, not right now when they've said in their letter they're going to go back 6 years. We've been warning people this is 2023. So I've been warning people 11 years about this, 11 or 12 years now about this. When I first met the guy in Idaho, Stan Crow, mind you, I got a degree in business management. I just do this for a living. I'm not even a tax person, right? And I knew immediately, there's 4 ways this fails. I now know it's 7 ways it fails. And every tax attorney I took it to. But it's funny, when people get 96% of the money back, greed kicks in. Like, all that money in my account, so I'll take my chances. Well, if the money's in the trust account with a fiduciary trustee managing it, what are you worried about? I mean, it's not like you keep your money in your mattress at your house. I mean, you have it down at B of A or Chase or wherever you do your banking. Well, it's just in a trust account at City National or Boston Private or, Cambridge Trust Bank or, one of the banks we use, their trust departments. It's not like your money's gone anywhere or it's with Schwab. Okay? It's invested for you in a way that you chose, by the way, as collateral for your note. You have the right to choose it. So, it's not like you're going to take that 96% and put it in your mattress. Of course, you might be safer putting your mattress because when the IRS comes knocking, if it's in a bank account somewhere, they're going to grab it. They're going to lean it,
right.
And then they're going to want, and then they're going to take most of it because they're going to take the taxes and they're going to take the interest and they're going to take the penalties. And you're going to agree to all of it because you don't want the consequences for fighting about it. So, it's always baffled me. Why would anybody, take the chances? But if I get 96, I'll take the chances. No, think through. My grandfather used to have a saying, and I can still hear him with his accent. He was from Zurich. His accent telling me, "Boy, think through the steps in the process." And he would play chess with us. You got to be thinking 5 moves ahead. He always said 5 moves ahead, all pieces on the board. And he would train you to think, But people don't do that when greed sets in. They'll literally throw something that's safe, secure, with a fiduciary trustee for something that I get 96% of the money. I'll take my chances. It's like Lord of the Rings. They got the ring. Oh, my precious. They're just
They
they're
get
all,
blinded by.
yeah, they're just not thinking ahead. But I tell you what, um, they'll grind us. And they'll have their attorney and their CPA and stuff just grind us, asking question after question. But they'll ignore. I've actually seen clients where their CPA told them not to do it. It won't pass the audit, and they do it anyway because they get 96% of the money. I'll take my chances. Personally, I'm hoping most of them get away with it because I think the government rapes us on taxes constantly anyway. You saw the paper I wrote. There's 151 taxes in a loaf of bread. 51% of a loaf of bread went to taxes. Taxes on the land, taxes on the seed, taxes on the fuel in the truck, taxes on the gas at the bakery to bake the bread. So there, you go to the grocery store, half that bill went to taxes in various forms, right? They're already consuming too much. So I hope they get away with it. I hate to say that, but because I don't want people to get harmed because they followed advice from somebody who knows he's lying. Stan Crow knows he's lying. And I'll say that right here. And if he wants to send me a nasty letter, I'll have that fight. He belongs in jail as far as I'm concerned. He does. He belongs in jail for tax fraud and what he's done to people. Because these people are going to get audited. The IRS already has his client list. They already know everybody he did these cases with. So they're all going to get audited. And it's sad. But these letters come out from the IRS and it panics everybody. And let's be honest, the IRS kind of wants that to happen. They kind of loosely word things when they send these letters out. And by the way, these are just proposed rule changes. They haven't been implemented yet. They still got to make it through the process. They can't make up their own rules. And they want to quash that so you pay more taxes. You just say, oh, I don't want to take the chance. I'll just pay the tax, right? And they do that on purpose, which is wrong. And if their motivations are not what you would think either. You think, well, their motivations are to just have people pay their appropriate tax. Well, no, they're very happy to motivate you to pay a little extra too. So, and you can read that in the wording that they use. But a little kind of sidebar here. There are some auditors that specialize in auditing trusts at the IRS that we have open conversations with. And that's called a best practices relationship, where I ask them questions and they ask me questions. We never talk about specific clients, but they email me questions about, hey, what about this investment, that investment? What's this? What's that? And I email them and ask questions about tax related stuff. And we have just this open dialogue. Most of them are really much more fair than you'd think, the IRS. They're not all bad. And there are some that are. In fact, they'll even mention guys they work with that aren't fair. But the majority of them want to do the right thing. Believe it or not, they actually do. I know we tar and feather them every chance we get. It's not the rank and file, it's the higher-ups that have the motivations for these things. But no, these letters come out all the time, and it's just a proposed rulemaking, and most of it doesn't happen anyway. But it scares everybody and quashes people from taking full advantage of what they have every right to take advantage on. But again, let me circle back. They don't care about us. And the reason is you're paying taxes on the income from the business, or you're paying taxes on the income from the real estate. Those are the two things we do the most of. We do a bunch of other assets, but we do mostly those. And now you're going to pay taxes on the income from the trust.
Exactly. Yeah. So really, it sounds like, it's just a huge, I guess, misrepresentation of what's actually going on. Like it's not even the fact that the monetized installment sales are going to be adjusted. I mean, like you said, you think it could be probably a couple of years by the time it actually comes into play. Like how they execute that for agriculture could be different. I mean, do you expect that, or do you think
we expect no change on the agriculture side whatsoever? We expect an entire quashing of everything on monetized installment sales as it relates to anything that's not ag related. And we expect absolutely no changes to what it is we do. Now, I'll tell you one of the reasons is there's a carryback installment sale note on probably 90% of the sale of a business. Most people that sell their business, the buyer uses an SBA loan. I used to own a business brokerage. I had 37 business brokers work for me. I've seen thousands of transactions. They're not going to quash installment sale. And the courts are very clear. It's in the tax code. They would have to change tax law in a way that Congress would have to change the tax law. And we are doing just a straight up installment sale. So there's just too many reasons why they're not interested in that. And they've expressed they're not interested in that. In the latest letter, they give seven ways. And 4 of the 7 we don't do. The other 3 you have to do, or there is no installment sale. So it's just, so we are not what they would call a similar transaction. We don't meet the standard of a similar transaction at all. I mean, we're not even close. But what's happening is competitors, all right, are taking advantage of this to, oh, no, don't do that. But we have a program. And they're blanketly calling all of these other programs. Well, that's not correct. Chevy had a recall of one model, and Ford saying, don't buy any Chevys, they're all bad. No, it was one model that was recalled. See, Chevy build,
absolutely,
yeah, Chevy builds a good car. Buy the Ford, buy the Chevy, whatever fits your needs. But you can't call them all bad. It just. But again, if you look at the people that are criticizing and read a little further, they've always got something they're selling.
At the end of the day, right? It's always something about that.
Well, and to be fully transparent here, a couple of the programs I know of that a couple of competitors sell are not bad programs. They're actually fine. They just may or may not be what you want to put your money into. All right. I mean,
right.
Do you want to give away 10 or 20 or 50% to charity someday using a charitable trust version? Do you want your money tied up to where it has zero liquidity if you ever need it? You're stuck for life no matter what. Do you want to follow those rules or follow this? I don't begrudge anybody looking into the other legitimate programs.
Got it. So I guess just to answer everybody's question, it's completely different, right? So that's the thing. And like a lot of people were commenting, asking about it. And even myself, I had to learn to a little bit. It's a little bit different than it sounds familiar. It's hard. Sometimes you hear, a green apple and a red apple. Oh, there's a red apple recall. Or do I have to stop eating all the green apples? Like, no, green apple is completely different. Like it could be a different farm, things like that. And people don't realize there's a lot more that goes into it. And like you said, that recall example is perfect. I would have never thought of that. It's so true. It's like, oh, there's I actually used to have an old Bronco or the new ones that came out, and it got recalled. Funny enough, I flipped it. So I was happy I did, but they got recalled, but there's still good Ford trucks. There's still good, Ford sedans, things like that. You're still going to buy a Ford, just maybe you won't buy that model, and like everything's still going to be fine. It's just, you can't get caught up in like the entire brand. And some people, they hear the same name sort of thing and they bundle it all together. But for everybody that thought it was something else, it is something else, and you don't have to worry about utilizing something like an installment sale to defer tax free. And even for the big dogs, they at this point, I think one of my favorite things from the old election was when Trump called out Hillary, and he was like, "You can't take out any of the stuff that I have in, because all the people that that pay you are using what I have, all these trust vehicles, all these tax vehicles. They take those out. Trust me, it'll never happen."
Yeah, she was never going to change the tax code because that would tax all of her donors. So, exactly. It's all talk. They're not going to change those things because, they talk about it. They never do. The sky's not falling. The IRS is just clamping down on something that's always been bad, never been tax compliant. It was bad from the very beginning. There's one person that's done most of them, thousands of them, and there's a dozen others that offer it, and they all should have been shut down a long time ago. The fact that this wasn't shut down back in 2012, 2013 is a reflection on the incompetence of the IRS itself, because this fails 7 ways. There was a Ninth Circuit Court of Appeals hearing, and I watched the YouTube video of the appeals hearing, and the attorney representing the IRS, I was wanting to finish her sentences for her. It's like, I didn't go to law school and I could have won that case. I mean, it was like, oh my God. She must have been her first day on the job or something. I don't know. It was
falling through the cracks, got nervous.
Yeah,
Right?
and then the other side making the argument for didn't even make a good argument. Even the justices that were sitting up there, the panel of judges were asking leading questions because even they saw that, guys, but they can't rule unless you ask, right? So even they were trying to help, but it was a case of just incompetence on both sides. And but the ruling went against him anyway, and it's still on appeal. So because the judges just weren't having it, so they went ahead and filled in the blanks because they know the law. And but the sad thing is, a lot of people are going to get harmed. And another sad thing is, a lot of people that would have benefited tremendously from one of the good programs are not going to take advantage of it.
Yep.
And they will unnecessarily overpay their income taxes. And that's money that could have stayed invested, working for them, generating income. Again, I say it on these vlogs all the time with you. We're not anti-tax. To have a civilized society functioning at the level our society functions, you have to have taxes. There's just no way around it. We're against waste. And truthfully, using our program will generate more income taxes long term than not using it. But you also get more income net of the tax. It's a win-win. It's why did they let you defer the taxes on an IRA or a 401k? Because they collect more taxes long term than if you'd have just paid the tax up front. But you also get more income net of taxes long term. Believe it or not, it's a win-win for both sides.
Yeah, it goes parallel to each other.
Yeah, so that's why they don't have a problem with us either. It's a win-win for all sides. It's a far more efficient use of capital and investments for both sides. So, but no, the sky's not falling. It's just a proposed rule change. It doesn't matter what they wrote in there. It still has to make it through. Most of what was written in that letter isn't going to make it through anyway. It never does. And, again, we spent hours and hours with legal counsel going through all these things. We're good. We're 100% good.
Sweet. Well, thank you for clarifying. Yeah, I know. I was about to say it. Thank you for clarifying the sky's not falling. I was about to say that before you said it for me. Everything's fine. The world's not ending. We're all going to be okay. One big, happy family still.
Yeah.
You can still live tax free. But Kevin, thanks again for clarifying for everybody in the comments. So for those of you that did comment, ask about it, hopefully we answered your question. If you have any additional, feel free to reach out, comment some more, send us an email, whatever you got. We're happy to answer for you. But like I said, Kevin, thank you again for clarifying, and everybody that did show up and listen. We'll catch you guys on the next one.
All right.